It's some of the things you talked about with HAFA. It sounds like what we've seen in the real estate industry. A lot of the guidelines and the things you guys set forth are starting to be adopted by the other servicers. That's why you have co-op short sales. We're seeing relocation. We're seeing pre-approved short sales.
Mhm.
So HAFA is kind of evolving. It's kind of changed the industry. And from the real estate perspective, we've got to really say thank you to your office and all the hard work that you guys have put in, because it's helped us, perform so much better when it comes to this. And, on that note of constantly evolving, some things recently have changed with HAFA, within the last 30 days. Could you shed some light on that?
I will, but I just want to go back to the point that you just made, because I think it's a really important one. The whole Making Home Affordable program is, in my mind, and of course I'm incredibly biased as the policy director, but nonetheless, US, so here we go. In my mind, is really a shining example of good government, good government at work. Through the HAMP program, the modification program, we have directly helped more than 1 million borrowers get a mortgage modification that you and I, as taxpayers, helped to support. But another 3 or 4 million borrowers got affordable, sustainable modifications that look a lot like HAMP, but that servicers did without taxpayer incentives. So we established a model. The model was built by servicers to support this program, and then it carried over into other aspects of their servicing portfolio, and now has become the standard. It was many of the things that we pioneered through Making Home Affordable: borrower communications, prohibitions against foreclosure at the same time you're working with the borrower on a mod or a short sale, single points of contact so that borrowers know who at the servicer they're supposed to be talking to. All of those things that we pioneered through HAMP and through Making Home Affordable were embedded in the Department of Justice sort of settlement with the big servicers. They're part of the new servicing standards rulemaking that's being rolled out by the new Consumer Finance Protection Bureau. They're becoming sort of the law of the land. And it didn't cost the taxpayers very much. We only paid for maybe 25% of all the modifications that got done. And HAFA's the same way. So if you look at the number of transactions that actually are official HAFA transactions, where the taxpayers had to pay dollars to make those transactions work, they're less than 100,000. But if you look at all of the short sales that have the HAFA components, the things that were so near and dear to my heart and important: release of liability, you don't charge the borrower upfront fees to participate, you give the borrower relocation assistance, all of those things, and caps on subordinate lien payouts, all those things that were important to us are being now adopted throughout the wider industry. And so I just think that that's really exciting. And the measurement of this whole program is not how many units got done under a label, but how did the industry change as a result of the models that we developed. So that's my really long-winded preamble to your question. But now I will talk about the new HAFA guidance that we rolled out on November 1st. We're real excited about this. Enthusiasm is a problem for me. I have trouble gearing up and getting excited. So, when we first rolled out HAFA in 2009, we were sort of in lockstep with Fannie Mae and Freddie Mac. And we all had exactly the same HAFA program. And as I mentioned earlier, it may have been a little over-engineered, but we were all doing exactly the same thing. Over time, we changed our program to streamline it a little bit, to do what changes that we thought were improvements. And Fannie and Freddie didn't necessarily come along. So not too many months ago, you really had 5 different short sale programs floating around. You had the Freddie proprietary short sale, the Fannie proprietary short sale, the Freddie version of HAFA, the Fannie version of HAFA, all of which were different, and then the Treasury version of HAFA. And so poor real estate agents, I don't know how you survived. I heard a lot of complaints, I must admit. I'm on speed dial for most of your membership, I think. But it was a mess. And so we worked really hard with the FHFA, which is the regulator for Fannie and Freddie, to try to bring this back into the fold and get to a place where there was really, again, one unified short sale program for the nation. And the first important component of that was the GSE alignment, which was rolled out, I think, September-ish. Both of the Fannie Mae and Freddie Mac came together and aligned their two short sale programs so that they operate the same way. We don't have 4 programs at the GSEs anymore now. We have 1, which was a really good thing. And we were especially pleased about that because after working very carefully with those agencies, they adopted for borrowers who have a legitimate hardship all of the key components that we've been talking about today. They said, yes, we won't charge them upfront fees. No, we will release them from liability. We will pay them relocation incentives. They just adopted all the things that were near and dear to our heart, as well as saying, and we do want to put a focus on pre-approvals. So we're not going to have lots of paperwork around that, but we do want to encourage servicers to do pre-approvals. And at the end of the day, if the property doesn't sell, we're going to encourage borrowers to give us a deed in lieu so that they don't. So we end the agony for them. So we were thrilled that they adopted all of those points. And it was not easy for them. I mean, this was a huge concession. Freddie Mac in particular, I don't think Freddie Mac ever did a transaction where they didn't ask for a borrower contribution. It was a standard part of their operating. And from their perspective as the investor, if you can get the borrower to give you money, it reduces your loss. So yeah, I mean, I can understand that from their perspective. If you look at it sort of on a macro level, however, it's not, we didn't think it was a good policy. So we were very pleased that they adopted that stuff. And then they turned the tables on us and said, okay, we've met you in all the areas that you say are important to you. And now we need you to make this easier. Get rid of all the paperwork. Streamline this for us so that our servicers don't have as much paperwork to deal with. So that's what we did. So the November announcement has a couple key components. One is that we have dramatically reduced the paperwork required. And by example, if you wanted to do a pre-approved short sale, both the servicer and the borrower had to sign a fairly lengthy contract. It says here all the terms of the pre-approved short sale. And if the borrower didn't return the contract in a certain number of days, these bad things happened, and then the servicer couldn't move forward. And there were just lots of timeframes and pieces of paper that had to go back. So we've eliminated that. We still have a document that describes the agreement, but it's unilateral. So the borrower and the servicer have a discussion. The servicer figures out what the value of the property is, and the servicer sends the borrower a document that says, okay, as long as you do these things, you're good to go. You've got your pre-approval. That document can be our form, which of course we think is wonderful. It can be the servicer's own proprietary form. It can be an email. Doesn't matter. Whatever gets the job done, as long as the key components are communicated somehow in writing to the borrower. So that's one of the things we did. There were a lot of other certifications that because we're the federal government and because we are overseen by the Special Inspector General for TARP and OMB and GAO and everybody, the whole alphabet soup of oversight bodies, we have to have a lot of certifications by the participants. This is an arm's length transaction. There's no money under the table. I'm not lying to you. I haven't committed a financial felony in the past 10 years. All this stuff that only we need to do. Other people don't really need to do it. But we've moved all that now to closing. So you can sign those certifications at closing. The servicer's receipt of things in between doesn't hold up the decision-making process. So we've really streamlined the documentation tremendously. We also have increased the incentives for the investors to pay off subordinate lien holders. So previously we said for every $3 you pay to a subordinate lien holder, we'll give you $1. But we're never giving you more than $2,000. It was some incentive, but it wasn't a huge amount. Most of the burden of paying off subordinate lien holders was on the investor themselves. So we have now we will pay up to $5,000 to pay off subordinate lien holders. We haven't changed the cap. The cap remains the same, but we will pay a much larger share of the amount that investors pay to subordinate lien holders in an effort to encourage them, because that's still a problem, as you know. It's never going to go away. It's just sort of inherent in the short sale concept. But so between the GSEs coming to alignment and us coming to alignment with them and reducing the amount of paperwork and increasing the incentives, we think that we now have a program that is universal, that is really easy to use, and hopefully will get great traction long after the Making Home Affordable program is gone. We sunset in a year. Our program ends at December 31st, 2013. But short sales will be around a long time after that. It should be sort of part of the standard lexicon for loss mitigation alternatives. And I'm very hopeful that these concepts that we've developed here, and especially with the November 1st announcement, will carry on for years and years and years to come until somebody invents the next new exciting thing.